Assalamu alaikum wa rahmatullahi wa barakatuh. So, brothers and sisters, inshallah, we'll discuss uh, the security in credit, which is our sixth chapter after we have learned the assessment. So, today we'll discuss the credit security. So, security we can be said as collateral or as a backup for any kind of financing, or it can be said as a pledge, even though there are different terms used in law. So here in this chapter, we'll discuss what is security, why the security is important for financing, and different types of securities, and what are the procedures, what are the rules, and legal conditions for taking an asset as a security. And then we also see from finance perspective when we are taking an asset as a security. So first, why the security is important? As we know, the security is called the last line resort when a financing fails. When a customer cannot pay back, then the bank will go for the security. Okay, so first of all, why the security is important? We need to know that all the financial institutions, they have a responsibility because they are using the depositors' money to give financing. So it is the responsibility of the bank to protect the depositors' money, so that they can mitigate the credit risk, so that they can get back the financing that they give. So because of this, even though all the credit assessments, the credit scoring that we have learned, yes, the credit scoring are done, but then again, security for a credit is taken, because credit assessment may not give us 100% assurance. It may happen that a person can default even though he has a good credit score. And then, but one thing to remember here, that collateral cannot be substitute for the credit integrity of a borrower. So even though there is a collateral, or we can say security taken, but it is not a substitute. Okay, means financial institutions should not rely on the collateral only, because if the bank always go for collateral, it's not good for the financial institutions. It has cost, it takes time, and then it's also reputational issue. So it is better the financial institutions, they focus more on the credit assessment, so that they don't have to go for collateral. And even it is not good for the customer as well, that if the customer does not pay back, we're hoping that okay, the bank can take the collateral and liquidate it, but it is not good for the credit worthiness or the of the customer. His credit scoring will go down. And then why the security is important, okay, gives a priority over other creditors of the borrower in receiving payment. So when an asset is registered that this is a collateral or mortgage for this financing under this bank, so or when the company or the person bank goes bankrupt, so at that point when there are many creditors, they come, so other creditors, they cannot take this particular asset which is taken as collateral. So in this point, the creditor will be safe. And then rights against specific assets of the borrower if the borrower has insufficient assets. So when a borrower, he goes bankrupt and he has many creditors, so and the asset is not enough to fulfill to pay all the creditors, so at that time, uh, the creditor that has got an asset as a collateral, he will have priority to take that asset. So this is the benefit of taking security for financing. So what is called good security, when we can say a collateral, an asset taken as a collateral is good. So first important thing is the marketability or liquidity. So if in case when the bank needs to liquidate to sell this asset, they need to consider that whether is it easy to sell it or difficult. You see, we can see an example like land. Okay, it takes long time, and it is sometime and then the place of the land. Okay, if the land is in a place which is far from the city, so it might be difficult to sell it. Okay, and then the accessibility, how to assess the measure the value. Okay, especially for real estate or for land, it is difficult to measure the value of that asset. And then another very important factor is the stability of the value of the collateral, because some of the assets, okay, the price are not stable. For example, shares. Okay, the share price always go up and down. Okay, or even the car, for example, so the price of car always depreciates, so they are not really stable. So a collateral that has a value which is stable, that is good. And then transferability, whether is it easy to transfer, whether the asset can be transferred. So again, it goes mostly to real estate. For some kind of assets, lands cannot be sold or cannot be transferred to others, especially in Malaysia. You have Malay reserve land. So this kind of land, it is complicated. So that's goes to another issue, absence of any encumbrances. Encumbrance means any barrier, any obstacles to, okay, that there are some assets that bank cannot just sell it. There are some barrier or obstacles for the bank to sell it. So it is in that case, the bank needs to make sure there is no any legal encumbrances, any barrier to sell off the asset. And then another thing is the speed of realizing the collateral value, how fast they can sell off the collateral. So in that case, maybe the fixed deposit might be very good one. It is very easy to fast and easy to liquidate, but land properties might be difficult. And then the enforceability, okay, how strong the legal system of that country, so that it is easy for the it is easy for the financial institution to sell off. Okay, there are some countries it is very difficult, and the legal procedures is so lengthy, and it takes so time that sometimes to sell off one piece of land to it takes maybe 5 to 10 years for a financial institution. So the enforceability, okay, the legal how the the legal position is strong enough or supportive enough to liquidate the asset is also important. So these are the characteristics for a good security. So the financial institution needs to check all these criteria when the customer offers an asset as a security. Okay, and then the types of security. So this chapter also has a lot of terminologies and perspectives from the law, because this then requires registration and what. So according to the English law, the securities can be divided into four types. One is called mortgage, and then charge, pledge, and lien. So as we can see in this table, okay, so there are some uh, so as you can see in this table, okay, so there are three criterias to actually to 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 differentiate between these four. One is the transfer of the title, another one the physical possession, another one the power to sell. So mortgage. Okay, let's look at the mortgage. Okay, mortgage is this mortgage is something. If let's say you are a customer, you okay, and if you want to put something as a mortgage, at that time you are required to give the title, the legal title, means to make it easy, the ownership certificate, but you are not required to give the physical possession. Okay, and then the financial institution has the power to sell the asset. Okay, the example can be like landed property, real estate, houses. Okay, so if you put house as a house can be put as mortgage, because house you cannot give the physical possession to the bank. Okay, it is not possible, but you can give the ownership certificate, and the financial institution has the power to sell it off. Okay, and then another type is called charge. So charge is something it mostly used for also real estates or houses. Okay, where you don't even require to give the ownership certificate, you just need to register with the land authority. Okay, so this is, I think, mostly practiced in Malaysia. Is charge, is called charge, means when you buy a house or you want to give your house as a collateral, so what you just need to do is you need to register it with the bank, with the land okay, authority. So they will register this your house, that it is put as a collateral and for this financing under this bank. So that is enough. So you will not be able to sell it off, because you want to, if you want to sell this land, you have to register with the land authority, and land authority will not allow it. So that is called charge, means here the owner, the financial institution has the power to sell this asset, but they will not hold the ownership title. However, the number three is the pledge. Okay, pledge is something where you don't need to give the ownership certificate. Okay, you rather you give the physical asset. So this pledge is mostly applied to like ornaments like gold and silver. Okay. So Al Rahnu is the example of the Al Rahnu, we can see the pawn shops. So they are the example of this pledge. So place is something you offer as a collateral, you give the physical asset. So like gold and silver. Okay, you have a 5 kg of gold, so you give that gold, 5 kg of gold, to the bank. Okay, to hold it as a collateral. So in that case, you don't have to give the ownership certificate, and the bank is entitled to sell it anytime. And the fourth one is called lien. Okay, so lien is something where you don't need to transfer the ownership title. Sorry, give the ownership title, and this is not possible. You give the physical asset, but here is the difference. Okay, that the financial institution is not able to sell it off. Okay, if they don't want to sell, maybe they need some kind of negotiation, then they can sell it. Okay, the example of it can be like your license, maybe your business license. Okay, so you took a financing, and then your business license is kept as a collateral. So the bank will hold the physical license, they will hold it, but the bank cannot sell it. They cannot sell your license. So this can be an example of lien. Okay, so now different types of securities. Some are common and some are very uncommon. So most common securities are land, stocks and shares, debentures, which is actually bond, and then cash deposits, or is really the fixed deposit. And there are some uncommon like life insurance policies. So actually, life insurance cannot be used as a collateral, but they can be supportive. If a customer has life insurance, it may support his financing, but it cannot be collateral. Book debts are like short-term debts that you are going to receive, or you can say it a receivable. So book debts also cannot be used as collateral, because there are a lot of uncertainties there. Goods, they are very uncommon. Goods like inventories or any others, even gold and silver, is not common for banks financing. Similarly, ships, aircraft, they actually cannot be taken as collateral, because the price, the value is very difficult to measure, and also the marketability to get the buyer is difficult. Another thing is a guarantee. A guarantee is not a collateral, but it also can be supportive. And sometimes it is compulsory for some kind of financing. Like for foreigners, it is compulsory to have a local guarantor. Works of arts also cannot be collateral because the price also varies and also is difficult to market. Jewelries, yes, it can be, okay, the gold and silvers jewelry, it can be used as a collateral. However, it is quite uncommon for financial institutions to take jewelries as collateral for home or car financing. However, it is quite common for pawn shops. This is under financing under a different scheme. Okay, so now is a look at the legal perspective, how to take the security and what would be the documentation process. Okay, so for land, when taking a piece of land, of course, it should come with the building. Okay, according to the National Land Code, we cannot separate the building from the land. It be together, and we need to perfect the charge document. So here, the concept of charge is applied. Perfecting means to do the necessary to prepare this document. So what will be a document? So there in that we need to prepare a charge document, perfect it. So in that document there will be the charger who is the actually the client, okay, and the chargee is the bank or financial institutions, and it should be registered at the land office. Okay, the customer needs to send the title document accompanied by a memorandum of charge. It should be sent to the land office, and then they will endorse it and then send it back to the financial institution for safekeeping the charge document. Okay, now come to stock and shares. Yeah, so actually, stock and share are quite same. Sometimes it's I think American or British English, or sometimes stock they mean inventories, but here we mean stocks are the shares. So there are two types of shares. One is the quoted shares and unquoted shares. So quoted shares means which are listed on the main board of Bursa Malaysia or the second board of Bursa Malaysia or any overseas stock exchanges. So these quoted shares are quite fine because when the company share are listed, so they go through the screening. The securities, like in case of Malaysia, the Securities Commission of Malaysia, they will screen the company, so that company screen through this securities commission, so they are more reliable comparing with the unquoted shares. So these are the shares which are not listed in any uh, stock markets, but they are mostly they are from private limited companies, means small companies like Sindirian Berhad. So they give their shares personally to their clients, okay, or some public listed the public companies, okay, the big corporations, but they do not sell their shares through the share market. Rather, maybe they are selling to their own clients. Okay, it may happen sometime like banks. They also sell their shares to their clients. It may also happen. However, these shares are actually not strong as like the listed one, as I said. So how to take share as a collateral? So there will be also a document. We need to perfect the documentation of stocks and shares. So it should must have these are the terms of this the documentation of stock as collateral. First, there should be absolute right of sale, means the financial institution must get the right to sell the shares. Okay, and then a first party deposit or a third party deposit. If the client he deposits the share that he owns, then it is first party deposit. Or if somebody else's share or somebody else owns the share, then it will be a third party deposit. That should be mentioned. Okay, so all the shares will be registered under the name of the financial institutions nominee company, because usually uh, the financial institution cannot directly buy shares. Rather, they will have their nominee company or wakil. Usually, like for Maybank, they have Maybank Securities, for example, or Bank Islam, they have Bank Islam Securities Berhad, a different company that are allowed to trade in the share market. So those company, okay, will be able, so the share will be registered under those companies, and they will be able to sell the shares. Okay, and there will be a legal document called the transfer of deed. So it is a formal document that the ownership is, the share is kept as a collateral. Okay, so how we need to calculate, the share. So it is just an example. So if we want to share the how much margin, or how much the loan we should provide against a share, so we can see here an example. So we first take the loan value, how much, and then divided by the market value of the share, multiplied by 100. So if, let's say, uh, 5,000 share of a company ABC, the market value per share is 9. Okay, so it will be 5,000 share, the price will be 49,000. So if the loan amount is offered is 25,000 to the customer, so how much is it? Okay, so we divide the 25,000, divide by 45,000, multiplied by 100, so equals to 55.56, means almost half of the value of the share. So we can say it is quite okay, because collateral, the loan offered should not be more than, I think 60% is better. So it is quite fine. Okay, now debentures. Okay, so debentures are bonds. Okay, and these are the bonds. Okay, of course you learn details about bonds and sukuk in Islamic capital market. So here, to generally understand what is bond is, it's a piece of document, it's a certificate that is issued by companies or corporations, and then based on their, and if you hold that bond, so they will give you some coupon or interest, usually annually or semi-annually. Okay, and this bond, for debentures, they do not have any underlying asset, rather it is offered based on the face value of the company. So if the company, let's say, goes bankrupt, and if you hold the debenture, so if you want to get back, okay, so it will be based on the how much asset the company has, means there is no fixed asset tied to this bond. Okay, which is different from other type of corporate bonds, okay, or government issued sovereign bond, or sukuk especially. Okay, where there is an underlying asset, where if the bond or sukuk fails, you can go and sell off that asset. But for debentures, there is no underlying asset, rather it depends on the company's overall asset, or we can say the balance sheet. Okay, so for debenture, and if some companies, okay, they offer their debentures as collateral, or somebody holds the debentures of a company and they offer it as a collateral, so this should be the document. Okay, so there will be terms where they need to define under this company what are the fixed asset, what are the floating assets. Floating is the asset coming and going, and price always changing, and then a restriction on future disposal of assets. So this company may not be able to dispose any more assets after okay this, and a restriction of future borrowings. Maybe the we should put restriction that this company may not be borrow further unless giving notice. Okay, and the power of attorney clause, means power of attorney is wakala, is that the financial institution has the ability to liquidate, to sell of the company's asset. And a reflotation clause, it is a clause where if they want to continue one more year, for example, another term for as a collateral. So that's so this is what should be in the deed of debenture. Okay, is the document for taking debenture as collateral. So now here, if we take any company's uh, debenture as collateral, okay, and when we want to calculate, okay, how much loan we should give, so usually we look at the balance sheet of the company. Okay, so and then at that balance sheet, we need to see the total realizable security value. Okay, not okay. So what is it? I'll come to this. Okay, so let's say uh, you want to give a 5 million loan to a company. Okay, so you want to give 5 million, and so this is the balance sheet right now of the company. So you see it has fixed asset, you have current assets. So if you add up all, you get actually this one is 9.2 million. So once you see the balance sheet is 9.2 million, and the company asks for 5 million, so it is 54%. So you may think it is quite good, you can give them loan. Okay, but this is not what a finance officer should do, because okay, when we look at the company's balance sheet, okay, at that time we need to predict what will happen at high point liquidation. High point liquidation is something where when the company will go bankrupt, the company failed to pay back, then at that time you'll go and take back the company's asset. At that time, what will happen? Okay, so usually when the company has is in high point liquidation, you are going to sell up the company's asset. Usually, the value of all the asset will go down. Okay, so there will be, you can see the expected recovery means how much you can actually get at that point. So here you can see the motor vehicle that the company have is 100,000, but at the time you're going to liquidate it, you are going to sell it, you have to sell it cheap because maybe no buyer. So you'll get actually 70% of it. The plant and machineries, the value of the plant and machineries, of course, will go down. Okay, very big. It will be 40%. Okay, so you can see, and then even the stocks, the inventory will be also 50%. The debtors, not all the debtors will pay back, for example, and there will be no cash. So if we predict, okay, like this, and if we add up, okay, we can see the actually the total asset at that time will be 4.9 million. So actually that is less than 5 million that the company is asking for. So it is not a good decision to allow 5 million loans, okay, even though right now the company has 9.2 million. But if we look at for the future, what may happen in worst case scenario, we can see that the company's asset value will go down at high point liquidation. That based on our estimation, it will be 4.9 million. So to be safe, it is good to allow for me up to maybe 3 million to this company. Okay, so now we move on to other elements like guarantee. Okay, can guarantee is a collateral? No, it cannot be considered as collateral, but it is sometimes required, like for students or for foreigners to have a guarantee. So we may need to make sure it is enforced. Yeah, okay, when the financial institution, when the customer fails to pay back, then the financial institution will ask the guarantor to pay. If the guarantor does not pay, then the matter will brought to the court. Okay, and then when there is a guarantor for any financing, so the credit officer needs to do the credit scoring for the guarantor, same like the customer. Okay, so if the guarantor also passes the credit assessment, then the financing will be given. And this is the document of a letter of guarantee. So usually there will be, the guarantee should be continuous. Of course, it should not be for okay. It is a continuous. It is irrevocable, means it cannot be cancelled, and it should be unconditional. Okay, and its stamping is mandatory. If not, the guarantee contract is not valid. And also there should be a statement that the guarantors are jointly and severally liable. Okay, so this is a legal term, which means jointly means together. If husband and wife, they are the guarantors, means they together. If husband pass away, the wife has to pay the whole. Okay, and severally liable means you divide 50-50. There are two guarantors, he will pay 50%, another one will pay 50%. That is called severally liable. So same with the corporate guarantee, okay, is the same. However, for corporate guarantee, we need to remember these two important things, because some companies act, because based on the companies act, there are some restrictions for companies to be the guarantor for something, and also the board of the directors resolution, the constitution of the company, whether the company allows, okay, the constitution allows for the company to be the guarantor for someone else. Okay, and then a cash deposit. Yeah, cash deposit is a good collateral. Okay, these are the fixed deposits. Okay, this called FDR, fixed deposit receipt. Okay, you this. So yes, it can be taken as a collateral, and it mostly from the same bank. Okay, you are taking financing from this bank, and if you have a deposit in that bank, so that is taken as okay, as collateral mostly. uh, so the documentation is a memorandum of deposit, okay, and then the letter of set off that the in case of default, the financial institution can just set it off, okay, and then the lien over the FDR, that's the lender, or is subsidiary company, okay, is anytime able to just take it. So these are the documentation required. Okay, so that's all. With that, I thank you. Assalamu alaikum wa rahmatullahi wa barakatuh.